All right, welcome everyone, and welcome, Mish. It has been a long time since we've done anything like this, and this is just the beginning, we hope. So let's just dive right into it. The RSP, the equal weight S&P 500, made a new high today, but we're going to come back to that. You put out a daily today that had some really interesting perspective on how people should be dealing with the upcoming Fed announcement. And we just did a webinar last week about your ultimate trading program, which covered a lot of market or phase changes, one of your favorite ways to identify how to identify potential trades. So I was just excited that we could get together, talk about all these things really quickly, dive into the details, and share your thoughts with the community. So let's dive right into it.
Well, yeah, just to say a word about that, it's very exciting to be able to do this with you, Geoff, because we've been together for 34 years, and yet the number of times we've actually collaborated on giving people our viewpoint and using our gauges to kind of show how the logic really basically is based on pure price movement and some of our classic ratios is really exciting. So I'm so happy we're getting to do this. But yeah, to your point about the equal rate, excuse me, the equal weighted RSP on the SPY making new all-time highs. What really has been the big question, and I've spoken with lots of different people, including doing an interview today at StockPick, is what do I believe here? We've got the Fed coming up. We have lots of risk-off indicators. We have a good percentage of people who think we're going into a major recession. We have the gold going to new all-time highs. Certain commodities also rocking and rolling while others look very disinflationary. I mean, really, I don't think I can remember a time where there's so much bifurcation, if you will, in the market. So with the Fed coming up, I think what we really want to do today is try to sort out, using the indicators, what's the most likely scenario, or even more importantly, which scenario should you be looking for and what's going to tell you. So looking at the charts of all the different risk gauges, right now I'm looking right at the RSP. Can we go back to that?
Yeah, so let's go to the risk gauges. And just before you jump in, I think the other thing that I'm excited about for this video, and as we keep doing this, is that our focus will be less on how to analyze what everybody's saying in the media about the current events, and more about how to just get right into how to trade them. So with that, dive right into this. This chart here, as you know, but I'll just share with the audience, comes from our Big View product and service. It's under risk gauges. It's the key ratios. They're what drive our gauges. But let's dive into the relationships. I know you're going to cover it.
Yeah, and this is really what got my attention when I was reading the weekend outlook that Don and Keith does. Keith does the bullet points for all the risk gauges, and at the very end, his comment was that all the risk gauges are pointing to risk off. And I'm thinking, wow, market looked so healthy last week. And as we know, starting today, it looked even healthier. How can that be? And I think this is what's confusing people right now. So let's see what we're talking about. So the first relationship there is the S&P versus the TLT. In a risk-on environment, the SPY outperforms the long bonds. And very logically, that makes sense because in the past, long bonds have been a flight to safety. We haven't seen that, of course, since 2022 because of all the interest rate hikes that we've had and the higher for longer that was sustained for like 23 months. But nonetheless, in a typical situation, you want to see the SPY outperform, and instead, we're seeing the opposite. We're seeing the long bonds outperform. So I think the first indication as we're going into the Fed meeting, whether they cut a quarter, whether they cut 50 basis points, we also have an election year and all of that, essentially what you want to ask yourself is, if this relationship continues and the SPY rallies and the long bonds rally, does that necessarily mean something's going to crack? And before we got started, Geoff said not necessarily, because that could mean the soft landing, right? So interest rates ease, the market is doing well, the economy, although a little bit slower from its peak a couple of months ago, actually starts to either stagnate or do better. Possible. What's also possible is that the TLT continues to rally and the SPY at these new all-time highs has some classic reversal. That's one of the things we have to watch for. If we move down to the next chart, this is probably, to me, the most interesting, because I have been a huge fan of junk bonds ever since I started watching them right before COVID, because junk bonds were the first thing to crash before the news came out about COVID. And so I saw this happening and I thought, wow, why are junk bond traders exiting so fast? And since then, of course, I also have seen when the market bottomed in October 2022, that the junk bonds actually turned up at that point, even before the market really proved that it had basically seen a bottom. So now we're looking at it from comparison to the long bonds, right? High yield debt, attractive in a risk on environment. Long bonds or 20 plus year treasury bonds, attractive in a risk off environment. So the relationship usually in a risk on would be that the junk would outperform the long bonds, but we're not seeing that right now. We're seeing actually the junk bonds underperform the long bonds. So this to me is your second clue. Does this mean end of days? Not necessarily. This can sustain for a while. However, you want to watch those junk bonds just like you want to watch the SPY. If the TLT keeps rocketing and the SPY has some kind of massive popping reversal pattern, or the junk bonds do, that's fair warning. If that doesn't happen, then perhaps, like we said before, soft landing is possible. Now, the next one to look at is also super interesting, and that is a relationship between the S&P 500 and the gold chart. And again, gold now at new all-time highs, and you have to say, what is gold trying to tell us? I mean, that's been the question I get asked over and over and over again. What is gold trying to tell us? And my pat answer to that is gold is acting like a mirror, reflecting the potential cracks, but they're potential cracks. And so people have been accumulating gold as a flight to safety. And obviously gold is doing better than SPY. But again, what does that mean? If the interest rates get cut and we see that rollover in the SPY and the rollover in the junk bonds, and yet gold continues, we can basically say, forget soft landing, forget hard landing, forget no landing. We're going into a situation called a stagflation scenario, which right now has been probably the most, I think, economic viable place for us to go at this point. We don't need to get into the reasons why. So gold could sell off and SPY could rally. That would obviously disappoint a lot of gold bulls, but it would be very, very good for the market and a good sign for the economy. So those are the three things that I've got in my mind. And again, regardless of what any analysts say, as Geoff said to you before, all you have to do is watch these relationships and then watch the prices of the charts themselves individually. And I think you'll have a pretty good idea how aggressive you should be in terms of investing, and also how protected you should be if you're already fully invested if things start to turn around. And even more importantly, maybe how underinvested you are in other commodities, which I still believe could see a huge run over the next few years.
Yeah, and I'll just summarize part of that and also say that people often think that risk off means that the market has to go down now. And right now, if the market is flashing risk off, it's kind of like a divergence. A divergence is only dangerous until, when the market actually starts to agree with the divergence. So if this is saying risk off for all the things that you're saying, risk off for me, it just means if the market pulls back, don't be so confident that that pullback is a safe dip to buy, because we're in a very risky environment. But if we get the soft landing, and if and the market keeps going up, doesn't necessarily mean that we're predicting the top from this. But let's go to the charts, right? That's where we really should be making that kind of decision. You ready to go there?
Yeah, absolutely. And the only thing I'll add to what you just said, which I 100% agree with, is that if the charts are telling you that risk off, but yet prices are still climbing, I probably wouldn't want to go in 100% long. I would want to diversify across different sectors for sure. I'd want to know kind of what my stop losses are. And just like Geoff said, I'd also want to look for signs that the risk off is becoming a little bit more insidious. But at this point now, we don't have to worry about it too much.
All right, let's get into the chart. So we're back here at the RSP, or the equal weight, but that's not really our focus right now, right? We're going to go to, which one do you want to start with?
Well, let's start with my dear little granny, because there's so much information just coming from that one ETF. As you guys know, my economic modern family, XRT.
Yeah.
As you guys know, Granny is in my modern family. She's married to the Russell 2000, his grandpa. And when you step back and look at the view that Geoff is showing you, we'll zoom out in a little bit more, but you can see just how volatile and range bound it has really been pretty much since the beginning of this year. And exactly what Geoff just said, which is, if you're going to be buying dips and your risk gauges are staying off, it could be dangerous, but so far buying the dips has been pretty smart, just like selling rallies have been really smart. So why am I totally focused on Granny? Okay. Number one is the interest rates, you would think, would spur the consumers. And there's so much information about the consumer right now. The savings rates are to zero, but in terms of how much cash people have in their houses, it's gone up like 38%. You have wages sort of flat, slightly rising, and yet people are still going out and spending money. You have stores like Dollar General that got killed, but yet other stores like Walmart near all-time highs. Some consumer discretionary did great last week. Today we had a little bit of fallout, and on and on and on. I mean, my vanity trade in terms of the obesity drugs, what that'll do, all of this sits right here. And this is 70% of the GDP, right? So the two things besides risk gauges that I like to use, or I should say the four things, not just two, because this has a lot of information, and all of these are our proprietary indicators, so I love them. Let's start from the bottom. The first one would be, of course, the momentum. And I love to look at the momentum, especially if there is a divergence. Like Geoff said, you can stay in a divergence, but sometimes the divergence is leading the price. Right now, what we saw was a mean reversion last week because the dotted line went back through the Bollinger Band. And even though the price is now sitting above the 50 and we're back in a confirmed bullish phase on the price, we're nowhere near the 50-day moving average yet in momentum. So that doesn't necessarily mean that Granny's going to stop rallying here, but it's certainly something interesting to look at, because when the momentum has cleared the 50, it really hasn't gone through that top Bollinger Band, not since April, really. So it's been a long time since we've seen this sector take the lead. And that's why I'm so focused on it, because if it takes the lead, we got a whole new ball game. Not a tech rally necessarily, but a much broader market rally. So the second thing I look at besides the momentum, of course, is the leadership. How is this doing versus the SPY? Because it's very healthy when you have a sector like this, especially the consumerism sector, outperforming the SPY, which it did briefly in July till we got into the early August when we saw the sell-off. And now it's back to underperforming the SPY. So the SPY could rally and the XRT could rally. But if you really want to say, oh, I should throw more money into the retail sector, especially maybe some of the consumer discretionary names that have been beat up, and spread yourself out that way, or just buy the ETF itself, if this starts outperforming, that would be a good way to do it. But it's not necessary for it to outperform, excuse me, excuse me, the SPY in order for this to stay solid. Then the third thing, of course, is the phase. So let's go back to the phase. So the 50 has been over the 200 for quite some time. So I always look at that. That's what makes a bullish phase, is when the 50 is over the 200 and the price is over both of them. And you can see, just going back from April, we've gone from bullish to caution to bullish to caution to bullish caution for a nanosecond. We looked like we were in a distribution in early August. Then again, as we got into early September, and now here we back into a bullish. And I want to say that this is very important. When you start to see phase changes changing like that, it means a much bigger move is coming. At this point, again, because of the risk gauges and the fact that it's underperforming and the momentum is not that great, we don't know if the next big move coming is a massive sell-off or a massive rally, but we know something's cooking here. And if you look at the two moving averages, they're getting closer together, but the slope on the 50 is still relatively positive. So at this point, if you're just looking at old school charting, you can see pretty clearly where Granny has to get over in order to see a much bigger rally. And right there at the top that Geoff's putting the cursor at 80. 80 is your number. So all of this really between, I'd say 70 and 80 has kind of been noise, lots and lots of noise. And that's really been very, I think, descriptive of the market in general, is it's getting choppy and volatile because we're directionless. And especially, as I said, given everything we just talked about, the risk gauges being one thing, the SPY making a new all-time high in terms of the RSP, but yet Granny kind of right smack dab in the middle saying, I'm not sure. Granny's representing us investors, right? We're not sure. The fourth thing on the chart, of course, is the calendar ranges. And if you look at the two calendar ranges, the red would be the 6-month calendar range low. The green would be the 6-month calendar range high. We've had a lot of fake outs up and down, but right now we're back through that low, number one. The 200 was right above it, so we cleared that. Now we're smack dab in the middle between the July high and the July low. So the information you're going to get from this is probably a good time to wait for some more clarity. So let's go on to the next chart.
Before we do, Mish, I get a big picture question for you. So if we just look back, before 2024, everybody got all excited about rate cuts. Granny took off. As the year came on, the rate cuts became like further and further into the distance. Now we've spent all this time consolidating, and now finally we're going to get the rate cuts. Do you think you can just look at this big range that's been established and say, well, if Granny breaks out to the upside, then the rate cuts are going to be viewed as soft landing, we're in good shape economically, versus if Granny breaks down to the downside, then rate cuts are really telling us a more negative picture, and the economy is actually getting weaker and not stronger. And in that way, just kind of look at Granny to tell us which way the market thinks the economy's going. And, Fed's going to cut. Like they're saying they're going to cut. The problem is, which way is the market going to respond? Would you use it this way?
You basically said exactly what I was trying to say, just in different words and probably a little clearer. Yes, absolutely. That's what I'm trying to say. That's why I'm so focused on XRT right now. Because there is two arguments on the Fed cutting. One is people are going to look at it as fear, and we're going into a recession because they waited too long to cut. And B is their timing was perfect. We're experiencing a normalization, and we're going to get this soft landing, and the market is just going to take off along with all the aspects of the economy in a softer interest rate environment. And Granny will be the first one to reflect it. Again, 70% of the GDP.
Yeah. And we're not going to necessarily know this, by the end of this week. This is a big picture play. All right, what do we want to you want to hit next?
Well, let's hit Nvidia because obviously all anybody talked about for the first 6 months of this year was tech and Nvidia. And in fact, after the market, you had an announcement by Intel and Amazon that they're coming up. Intel's going to provide chips for Amazon, and Intel is up 10% in the after hours. Whether or not this sustains, we don't know. But tech is going to be very much part of the conversation forever, because let's face it, we're in a tech world. But there's been a lot of talk, including from us, about this great rotation. And some of the sectors in the market have done better now than technology. And tech was actually one of the first areas to sell off. So now it's come back a little bit. It didn't quite make it down to the August lows. And you can see that Nvidia, which is such a great example of our sister semiconductors, another member of our family, of course, this is perfect. Let's go through the bottom chart. Momentum wise, it had the real the mean reversion. But look, if we go back just a little bit, Geoff, to when in July, when it broke down under the 50, while the price was still really close to the highs, this was the classic momentum diversion that was telling us that the momentum was starting to show a bearish divergence, even though the price hadn't, and that big red bar that we had corresponded with that. So that was really where we started to say, gee, tech looks like maybe it's topped out for now. Not forever, but topped out for now. So now the momentum is not really showing us anything too cool. In fact, even though we've had this mean reversion, you could see the dots are turning down, so that may not sustain itself. Now, the other thing, if we look at the middle chart, is the leadership. And tech led forever. I mean, pretty much until April it led, and then you had a little bit of a sell-off here in Nvidia, and then it started leading again as we were going into June and July. Once again, tech could, just was going to be the only area, the whole Mag 7. And now, if you can see that we had a brief moment where it outperformed the SPY, and now it's back to underperforming the SPY. So if you add those two together, it means that semiconductors have to do something really spectacular to change the scenario right now. And again, if we tie it back to the Fed cutting may not necessarily be all that influential to the tech sector. So I've read some theories on that, but they have so much money in the tech sector, they're not really worried too much about the interest rates, of course, unless they went much higher and showed that we were in some kind of a major inflation or major recession. But a cut here and there, this is not the area that's going to be impacted the most. Now, if we go up to the price chart, we were trying to get it back into a bullish phase, but look at the slope on that 50-day moving average. It's actually been negative. So even we need 2 days to confirm back to a bullish phase. We got them as of Friday, but today we're back into an unconfirmed warning phase, which doesn't surprise me considering the slope on that 50 is kind of negative. And look at that 6-month calendar range low. That's actually almost a convergence between the two. So we see Nvidia below the 6-month calendar range low. It's been there before, but it's there again. We're seeing it below the 50-day moving average with the declining slope. Been there before, but we're seeing it again. We're seeing it underperform. We're seeing momentum not all that great. So this is going to be another chart that will be interesting to see when tech might become popular again, or are we going to have another sell-off and another potential buy opportunity. Personally, I was hoping Nvidia would get back down to around 85, 90 to be a buyer. So I'm kind of sort of selfishly happy that we didn't see any major rally from these levels here, because it would have been really hard to pay up for it.
Yeah, I totally agree. I think, if we just go back and look at what a good rally looks like, you've got your leadership up above the red line there, and you've got your momentum up above the 50, and that's when everything looks great. And that whole dynamic just eroded, as you pointed out, to the point where we are right now.
And look at go back to the momentum, Geoff. You had a death cross there. The 50 crossed below the 200 recently on the moving averages, where we're still above 50, still above the 200 on the price. That's like a classic bearish divergence.
Yeah, if we were only looking at real motion, this pop back over the 50 in price, unable to get over the 50 in real motion, and then back under the 50. That's just a different iteration of what we were talking about risk off. I mean, this is one way of looking at risk off. You don't have the momentum, but it becomes a problem when the price starts agreeing with it. So yeah, so just maybe this is getting a little bit in the weeds, but since we focused on these two areas, you've got this consolidation, like this action around the 50. It also happens to be the 6-month calendar range, but we'll go into details on a different video on that. How would you be playing this if you were thinking about whether or not you should be buying Nvidia? So let's just say you're a trader out there, you're just getting used to phase changes and wondering how to handle this situation.
Well, I don't, like I said, the slope on that 50 is negative. So even if we popped above it, that probably would not convince me to be a buyer of Nvidia over, let's say, that 120 level, which it tried to get to last week. So for me, at this point, I would rather use the phases based on the 200-day moving average, which at around $90 is more in line with a valuation of this stock that makes sense. This has been a stock that was so overvalued compared to PE. People might argue with me on that, but just total number crunching. So I'd look for a correction, which we have not had down to the 200. My God, look how long it's been since we've been at that 200. I mean, look where you just go back to here, 2023. So that would be a really good opportunity, at least initial pop from there. Whether it sustains, we don't know. The other thing too would be to look at a weekly chart. And the weekly charts, you can actually go to a weekly chart up there if you just switch from daily to weekly. If you look at that weekly, that 50-week moving average, we've also been above that since 2022. So I love that weekly moving average here because it shows that we're still basically in an uptrend. We're just in a correction, and maybe the first correction down to the 50 that we've had since it took it out back in 2022, since that low we saw in October 2022. So if you don't want to buy it at 90 and you want to see how much lower it can go, you can keep your eye on that 50 level. Or if you buy it around the 85, 90, use that 50 level as sort of your stop loss.
Yeah. Yeah. All right. Well, the idea of these videos are that they're short and concise. So I think we should call it a wrap. Those were two great examples. I'm going to go back to the daily and just reiterate something that you said, because I know from doing the webinars and talking to people that sometimes this nuance gets missed, and it's so important. I wasn't trying to lead you into saying, where would you buy this? But I did leave the door wide open for you to be able to say when to buy it. And you flat out said, look at that slope. And I think the slope is so important, and people need to just hear that again. When you've got a negative slope and some other reasons like real motion, like leadership, there could be others, could be other support. Slope's important. Just because just because you get a phase change doesn't always mean that's the best time to buy. So that was a nugget I didn't want to let go. And I think we're going to have a lot of fun doing this. I hope we can do this every week. I know that's what we're secretly thinking. We're not telling everybody that, but I'm looking forward to it. And unless you have any closing thoughts, I am going to say let's call it a wrap, and hopefully people will watch the markets more than the talking heads to figure out which way the market goes after the Fed does its thing.
Yeah, and I just want to say, I talk to a lot of people. Obviously, I'm all over the media, but yet it's so thrilling to me to be able to talk to you and use our stuff, because we don't just talk the talk, we walk the walk, and all of the different indicators that MarketGauge has put together through the years, I use like it's religion in terms of making the trading decisions. So it's great to talk to Geoff, who actually is the creator of a lot of these things, and then bring to our MarketGauge audience how we look at them and use them.
Yeah, I use it too. It's going to be great to do this live with people also. And speaking of live, what are you doing later this week? Are you in terms of your appearances?
Well, I have a couple of really interesting ones coming up. One is more talk. There's no video, but Mario Nawfal Space has invited me on a half an hour before the FOMC announcement is made. And that's a really great one because they have a lot of people who are really, really smart and really fundamental and have no clue on the technical. So they bring me in to say, hey, Mish, what are we looking for? What do you think? Blah, blah, blah. And then Kitco, I do Kitco interviews a lot for the actual written part of it with Niels Christensen, but I'm doing this with Jeremy Sazfron. This is going to be on video, and this is really going to be what our projection is for gold and for the economy and what sort of trends will we be looking at, a lot which we covered today, based on the technical charts after the Fed announcement. So that's coming up. But Real Vision is next week. I'm all over the place. So.
All right. Well, everybody can, when they get your daily, you've got it all outlined in the daily. You've got your schedule there.
Yes, always there.
They can read the daily. All right. Thanks a lot, Mish. Looking forward to the next one.
Me too, Geoff. Thank you.
Have a good one.
You too.